Here to dive into industry trends with leading ETF experts, this is ETF Spotlight with Neena Mishra.
Hello and welcome to ETF Spotlight. I'm your host, Neena Mishra. My guest today is Holly Fremsted, US Head of Product Segments at BlackRock, which we know is the world's largest asset manager. And today we will cover factor investing and some other interesting topics as well. Holly, welcome and thanks for joining us.
Thank you so much, Neena. It's great to be here.
So let's start with the very basic question. What is factor investing? And factor and smart beta are often used interchangeably. So please also explain what is smart beta and are there any differences between the two?
Yeah, I'm happy to. The terminology factor investing and smart beta are often used interchangeably, and it's really for good reason. Factor investing is a style of investing that harnesses broad and persistent drivers of return. Most commonly, factor investing leverages style factors. So things like value, quality, momentum, smaller capitalization as examples. These investment styles probably sound familiar as I'm saying them. They tend to be very well understood investment themes. And the way that they come to life in portfolios, the way that they're leveraged to drive returns, can be in long-only investments, long-short investments. They can be used, factors as styles can be used in active rotation strategies. They span asset classes, so they manifest themselves in stock portfolios, bond portfolios, multi-asset portfolios. So factor investing as a category is quite broad. Smart beta is a subset of factor investing that takes these principles and invests typically long only, typically in index-based structures. So think of it as one style of the broader category of factor investing.
That's very helpful. Now, tell us how investors can use these factors to reduce portfolio volatility or improve portfolio returns.
Yeah, I think it's really important just to level set that there is not an unlimited number of what we would consider an investment factor. In fact, there are only a few. To consider something an investment factor, which when we say that, we mean something that is rewarded, systematically rewarded in a portfolio over time, it really has to meet 4 criteria for us. First and most importantly, it needs to be value creating. So again, it needs to add value in an investment construct. Second, though, and equally important for us, is that there needs to be an economic rationale driving those returns. So we have to understand why value, as an example, has historically worked in order for us to believe that it will continue working moving forward. This is what allows us to overcome what some might critique or be afraid of as kind of back testing bias. You created a portfolio that looks great and a back test, is it going to deliver going forward? This economic rationale is really what gives us confidence in the factor's ability to deliver performance on a forward-looking basis. The third criteria is that it must be diversifying. So in order to consider something a rewarded factor and not just a different expression of an already known and understood investment concept, it has to add something new and unique to the portfolio. So most saliently here, I think of value and momentum. They tend to be negatively correlated. They're delivering on very different investment concepts. And as a result, they are additive to each other, alongside each other within a portfolio. And then finally, the factor must be implementable. So when we're talking about the identification of these investment concepts, they're typically being identified in research, in a long-short setting, in a frictionless environment, paper portfolios. And so in order to consider something an investment factor, it must actually be something that we can trade in the real world and still realize returns. When we apply those 4 criteria, value creation, economic rationale, diversification, and implementability, we come to 5 factors that we consider to be rewarded. 4 of those factors typically enhance returns in a portfolio. That's value, quality, momentum, and size. And the 5th factor is predominantly delivering on a better investment experience through lower overall risk. That's minimum volatility. So these 5 factors have historically either been additive in an absolute sense to return, have been risk reducing within the portfolio, and all through that either better returns or lower risk have delivered better risk adjusted returns.
So let's talk a little bit more about these factors, the five main factors that you mentioned. Value, small cap or size, momentum, low volatility or minimum volatility, and quality. So these are the five main factors that are usually associated with higher returns, that is according to academic research, and these are widely used in factor strategies. Now, small cap, size, and momentum may be somewhat obvious, but definitions of quality and value varies widely. There are so many different metrics that can be used to define value or to define quality. Similarly, minimum volatility approach that BlackRock uses, that is somewhat different from low volatility concept that is used by some other ETF providers. So I'd love for you to explain to our listeners how they should think about these factors.
When I think about each of these factors, they're delivering on what for many are fairly intuitive concepts. So if we start with value, really what we're saying is we're investing in companies that are priced inexpensively relative to their fundamentals. Now, how you define fundamentals, how you define inexpensive relative to those fundamentals, certainly there are multiple metrics that can be employed. The research really started with Graham and Dodd in the early 1930s and then has been expanded in many studies since, but most seminally through Fama and French's research in the early 1990s. And in Fama and French's study, they used book to price. Now, there's been a lot of discussion about whether book to price is still a valid way to measure a modern growth company, as an example, where there are increasingly more intangibles. I think for us, it's less about negotiating which metric is better than the last, but really more importantly, ensuring that we're incorporating multiple metrics of valuation into our definition so that we're getting a diversified cross-sector view. So value is really about buying companies that are priced inexpensively. And there are a lot of reasons why stocks could be cheap. Many value-oriented companies, for example, have incredibly long, stable, robust business models that require property, plant, and equipment that make them very operationally efficient, but perhaps a little less flexible. And so there's some risk in the inflexibility of a business model like that. Think a car manufacturer. You should be rewarded for bearing that risk over time in your portfolio. So value exists for a reason that we understand. It can be measured in a lot of different ways. And I think more important than debating the ways that you measure it is just ensuring that you're taking a very diversified approach and using multiple metrics so that you can capture all of the various dimensions of value that exist. Momentum, which I appreciate, your comment was that momentum is a little bit more well understood. And it's funny because in many cases, we get a lot of questions around momentum that are perhaps misunderstanding the phenomenon, certainly as research has identified it. Momentum tends to be that securities that have been trending for a while in the market, call it 12 months or so, tend to continue to trend for about another 12 months before they revert. So a momentum portfolio is constantly being refreshed. Today, it looks a lot like what most have thought momentum is. FANG stocks, as an example. Tesla, Apple, Amazon, those companies that have been driving the market this year are all prominent components of our momentum ETF, MTUM. But that's more a function of the fact that their performance has been sustained over many months, that has been captured and is now displaying momentum. So momentum is about investing in trends. It's about investing in what's been winning, but it's not about investing in what's been winning over the last day or week, but really what has been demonstrating a sustained trend over the last 6 to 12 months. And then just quickly to touch on quality, because I think you're right, low size is fairly intuitive. Quality stocks tend to be companies with very durable business models. They tend to have lower leverage, strong and stable balance sheets, stable earnings. And this concept of really durable business models has been incredibly resonant this year. In fact, through June, so really through the kind of thickness of the pandemic and the worst of the crisis, QUAL, our quality factor ETF, was the largest asset gathering fund, I think in part because many recognize that in a very challenged economic environment, companies that are carrying lower debt, that have greater stability in their earnings over time might fare better in that investment environment. So there's a lot to kind of unpack in the definitions and what we think of when we're investing across factors. But I think the common theme for me is that they're fairly intuitive at the surface. They're delivering on what they say they're delivering on. Value is cheap, quality is robust as examples. But that when you unpack that, how they manifest themselves in a portfolio is certainly nuance there between providers and across the market cycle.
Excellent explanation. So one thing which we have seen is that these factor returns are generally highly cyclical. And we all know that timing the market is never easy, never possible. So how should investors use these strategies in their portfolios? Should they use a combination of factor ETFs, or should they use multi-factor ETFs or factor rotation strategies?
I would say the answer to how to use factors really depends on who you are as an investor. So let me just start with kind of a baseline. Factors, the style factors that we're talking about here, have historically delivered over, call it the last 15 to 18 years on average, about 50 to 250 basis points of returns above the market return in the US. The multi-factor portfolio, so one that is providing exposure to all of these factors, has delivered around 150 to 200 basis points of outperformance. Again, these are broad averages, but that's the kind of the level of outperformance that historically we've seen in this type of investment. As you say, though, that experience, an average over 15 years, is highly cyclical. We are in one of the worst, most extended periods of drawdown for value as a factor that we've seen in decades. So value has been challenged, while factors like momentum and quality and minimum volatility on average over the last few years have experienced far better returns. So recognizing the cyclicality of factors, I think there are a couple of key rules of thumb that investors can use as they're thinking about implementing. First, diversification is key. Every portfolio should have diversification to a variety of characteristics that will drive returns, factors being one of those. And that might come through multiple single factor investments, like pairing VLUE, our value factor ETF, with MTUM, our momentum ETF. It can come by pairing QUAL, our quality ETF, alongside perhaps a value active manager in your portfolio. So style box investments are very compatible with factor investments. Or it can come through tactical tilts within a portfolio over time. So I think making sure that you have exposure to a broad diversified base of factors is number one most important. And then number two, if you are going to be making tactical decisions in your portfolio, recognize the drivers and the levers that impact factor cyclicality, things like valuations of factors, the economic cycle, momentum, or the relative strength of factors. All of those can impact performance over time and can be used as triggers or as signals to determine how you should think about tactically holding them. But I think for most investors, just a strategic allocation to a diversified set of factors through multiple single factors, through a multi-factor fund, or through factors alongside style box investments is really how we're seeing it implemented in most cases.
And as you mentioned, these factors can improve performance of a portfolio, but some investors may not realize that they have no factor exposure in their portfolios. So could you talk a little bit about some of the risks of not having factor exposure within a portfolio?
Yeah, it's a fascinating question, because I think this concept is surprising to most clients when we're doing portfolio engagements. And we've produced a number of studies across institutional client portfolios, as well as financial advisor and wealth client portfolios, that all sort of end up demonstrating a very similar investment outcome. I will say that having neutral exposure, or having no substantial overweight to factors relative to the market, isn't necessarily a bad thing. iShares has a lot of assets benchmarked to market cap weighted indexes. Those would be neutral to factor exposures in a portfolio, particularly core exposures like an S&P 500 or a Russell 1000, just as a couple of examples. There's nothing wrong with having market-like exposure in a portfolio. as long as that's what you've intended. I would say most often what we find when clients bring their portfolios to us and ask us to run them through our Aladdin risk analytics system and help them understand perhaps some changes that they can make, what we often find is that a portfolio that has an accumulation of funds, whether those are active managers, whether they're indexed products, whether they're factor products, that when they are combined together at the portfolio level, your managers are actually canceling each other's bets, and you end up with an exposure that looks like the market, but you have built that exposure with far more expensive building blocks. And so neutral exposure to factors in itself isn't bad, but it's important to understand where you are unintentionally neutral to factor exposures so that you don't overpay for that bet that is effectively the market. I think the second key thing and the key trip up that we tend to see clients take is that they will select managers without any regard for their factor exposures, or perhaps, I think more honestly, without a real clear way to measure the exposures of their managers. And in this case, negative exposures to factors that tend to add performance in a portfolio over a long time can provide performance headwinds. So it's important to understand the factor exposures that you do have in your portfolio, because to the extent that you have an anti-momentum bias or an anti-quality tilt in your portfolio, you should recognize that over time, that will provide potentially a greater hurdle rate for your managers to overcome, or for you as the portfolio manager to overcome in order to deliver returns. And then finally, understanding when you do have positive exposure to factors, that those might provide tailwinds to performance are important as well. And that's obviously where I spend a lot of time talking about our factor products with clients, or around how they can be additive in a portfolio. So whatever direction you choose to take in factor exposures, I think it's important to understand what you own in individual products, understand how those products combine at the portfolio level, and then make sure that the risks, the headwinds, the tailwinds that you're introducing are intentional, because they can have a real impact on performance over time.
Excellent. Yeah, it's very important for investors to understand what they own and what kind of exposure they actually want to own. So now let's talk a little bit about the trends which have been driven by this health crisis. We know that some stocks that benefit from stay-at-home, work from anywhere trend have done really well this year. Now let's look at those from factors lens. Tell us how these factors have played out during the pandemic. And then my following question would be your outlook for the fourth quarter.
Yeah, it's an interesting conversation, because I think I'm happy to talk about markets this year. And I think it's actually less of a dialogue around factors and more a dialogue around the incredibly unique situation that we've been in. This has been, I think, the most challenged year in recent history, in like the last 15 years, for factors broadly. And I mean all factors. I don't think that is a statement about value working less well today because of the pandemic, or momentum working less effectively today than you maybe would have expected because of the pandemic. When we're saying that factors have struggled to outperform the market, it is really in relation to the market broadly and relative to their relevant market cap weighted index. And I think what we've seen when we think about the market composition this year is that the markets have been incredibly narrow. I mean, 5 stocks make up more than 20% of the S&P 500. If we look at the returns, it's hard, right? FANG plus Microsoft through the 5th of this last month, was up 7.6%, while the S&P was up 7%. So what that tells me is the markets in aggregate, outside of these largest names that really have been driving the markets, are down. And in that context, any delta between factor returns in the market broadly are much closer. They're much more closely aligned. So I think we've been in an incredibly narrow market. It has certainly challenged factors over the short term, but factors really tend to perform over full market cycles. And so as a result, I spend less of my time outside of extraordinary markets like we're in right now, less of my time talking about or decomposing returns for these factor funds over shorter horizons, because they tend to be trends that play out over longer periods of time.
let's talk about your outlook for the fourth quarter. We know that not only this year, value has underperformed growth for the past decade. And I must add that we have seen these mini rotations into value sometimes. For example, in September, but growth keeps coming back, and similar situation with small caps to uh, small caps have underperformed large caps, mega caps that you mentioned, those five stocks significantly this year. Of late, they have started, shining. So we don't know whether that is the start of a trend which is here to stay. So talk a little bit about your outlook for the fourth quarter.
Yeah, so let me throw a few qualifiers into these views. First, we update our factor rotation views on a monthly basis. So we don't produce for the remainder of the fourth quarter views. As an example, we're constantly evaluating new information that's coming in. Second is I'll talk a bit about the economy, but the economy is only one input here. We believe when we think about factor rotation that there are really, I think, three most salient criteria to consider. First is the economic regime. So where are we at in the economic cycle? Because that will tend to drive long-term trends over time. But the second is that if you believe in value and momentum as factors on their own, that buying things that are priced less expensively or things that are trending will continue to be a winning investment, then we also, when thinking about factor rotation, want to incorporate the value of value or the value of momentum. So we're looking at valuations of the factors themselves. And we're also looking at relative strength or the momentum of the factors themselves. So the three of these things come together to form our views of factors and what we think is going to perform best over the near term. Right now, when we look at the economy, in fact, what we're seeing in all of our own internal models, which are now casting models, so they're pairing real economic data with some big data to help kind of form our views of where the economy is going and what its growth or change in growth trends are going to look like over the near term. And our outlook on the economy has been improving. In fact, we have jumped to an expansionary regime environment in our factor rotation model using the economic data that the BlackRock Investment Institute puts out. And as a result of that, in those periods, you tend to favor risk on factors. So value and momentum, as examples, tend to be favored in these expansionary, more bullish regimes. Factors that are more risk reducing, like minimum volatility and quality, tend to be less favored. But again, those aren't the only things we're considering. And there's certainly a whole lot of noise that's happening, whether new policy is going to come out and change the rate or the pace of economic recovery. Big data helps us kind of temper some of the bullishness that the hard economic release data has been fueling in the market. So when we take into account all of these views, at this stage, we are moderately overweight value, and we would fund that moderate overweight with a moderate underweight to minimum volatility. This is looking at the fact that value has been underperforming, and so it is quite cheap. The value of the value is very compelling right now. The economic regime is bullish enough, using, again, hard economic data as well as big data to tell us that value should perform well moving forward. And as a result, we're going to temper our risk-reducing expectations in minimum volatility. So I think it's important to recognize here that as we talk about what's going to perform best, or at least what we believe will perform best over the short term in this concept of factor rotation, we're investing in all factors at all times. These tilts that we're implementing in our factor rotation models are fairly modest. They're tilts, not timing signals. And we're incorporating more than just the economy when coming to the conclusion that at this point in time, value is where we want to be overweight.
Very interesting. Now, we could talk about factors for hours, but I wanted to cover some other areas too today. And one area that is getting a lot of interest from investors, and we are getting a lot of questions from investors, that's about international investing. And we know that US stocks have outperformed international stocks over the past decades. And now international stocks not only look attractive on valuation basis, there are many other reasons also to look at international stocks. For example, some of these countries have been able to contain the virus much better than in the US. So investors are asking about those stocks. So tell us why investors should consider adding some international exposures to their portfolios now.
Yeah, you make a lot of compelling points there. In fact, I'll say as a little personal anecdote, I have a sister who lives outside of the U.S. I won't disclose where she lives, but we're continuously having fun kind of collegial debates over whose country's handling the coronavirus better, and and what measures do you use to determine that. But yes, I will say some of the some economies outside of the U.S. certainly seem to be opening up a bit faster and recovering a bit faster. I think there are really, when we think about international investments, 4 key reasons to invest today. And you are right, much like value, international investments have not delivered relative to the U.S. for so long that investors have become very US-centric in their portfolios. So I would say the first reason to consider international investments now is I will go back to the performance of the US markets. Diversification is a challenge, and it has been a challenge. We see, again, the top 5 stocks in the US market drive about 20% weight and have been dominating returns in a market like today. Now, there is nothing wrong with that. A market cap weighted index is intended to deliver market-like exposures, and these stocks are driving the market now. But for anyone who has reduced their international allocation and is focusing on the US, recognizing the extra concentration that you're taking in only a few stocks, I think is incredibly important. And as we're starting to see greater growth and faster growth, perhaps coming from international markets, having exposure to more companies that are more highly exposed to those growing trends, I think is key. The second is that international assets make up 75% of the world's GDP, and yet the average US investor is significantly underweight. So we have really become, as US investors, very entrenched in this home country bias, which has, quote unquote, worked for us from an absolute returns perspective over time. But again, I think we need to understand the diversification or the lack of diversification that may be introducing into our portfolios. Third is the deglobalization trends that we've seen. So we have increasingly seen more and more countries focused on investing locally. And as a result, especially on the heels of US-China relationship deterioration, we're potentially seeing a more bifurcated set of supply chains for companies, which might mean that US mega cap stocks alone are no longer going to give you exposure to that global growth of the economy than they perhaps previously had, which might mean we need to think differently and more expansively about, again, the diversification and the growth benefits from investing abroad. And then finally, I think the global middle class is something that is not well understood or certainly well followed. There's a lot of more salient news stories today, but the global middle class is the fastest growing consumer group, and 90% of them are expected to be located in Asia. So when we think about the fact that this could help accelerate growth of companies outside of the US in particular, it just gives us one more kind of mega trend forward-looking reason to consider investing in a portfolio that's incorporating more of the growth globally than just domestically.
Those are some very compelling reasons. And you mentioned Megatrends. And I saw that in recent weeks, iShares has expanded its Megatrends suite. So could you talk a little bit about those launches and also touch on the investor demand that is being fulfilled?
Yeah, megatrends are a theme du jour. And I think part of it really comes from the environment that we have been in over this last year. Some of the key trends and themes that we have been talking about, technology being one of them, have become far more important to our day-to-day lives in this world that has become increasingly more virtual, I think, than anyone anticipated over the near term. So as we were projecting these would be long-term growth trends, we've seen an acceleration of quite a few of those. If I take a step back, though, when we talk about megatrends at BlackRock, we believe there are really 5 key superhighways, and that we categorize under this megatrends moniker. Those are technology. So these are areas like AI, cybersecurity, networking, data, et cetera. And we should recognize that technology is salient in all of the megatrends, despite the fact that it in itself is a trend we believe is going to be accelerative. Second are demographics. So I alluded to that a little bit in the Why Invest Internationally segment of this discussion. But I think, what we're really seeing is increasingly aging population. And as a result, investments will likely change. Urbanization and really rapid urbanization. We don't think that this is derailed at all by COVID. I think a lot of the key trends, particularly in the emerging world, will continue when we come out of this pandemic. It's not about, someone who lives in New York City deciding to move to Connecticut to get a little bit more space because their commute might not be as relevant in the future. Really what we're talking about is move from the countryside to far more urban areas, particularly in the developing world. Fourth is climate change, and we can talk a little bit about that if we dig into kind of what funds have been performing the best and what's been most salient. And then finally, emerging global wealth. So I think the interest in megatrends as a category is because, in part, these are I think themes that are all kind of very relevant to us, but certainly accelerated by the environment that we've been in. They've become far more tangible to our day-to-day than we ever expected. And just to put a couple numbers behind this, BlackRock expects that this category will quadruple by 2024 to more than $250 billion in AUM. So we don't think that this segment is niche or small. We think it's only going to continue to grow.
So you also mentioned ESG climate trends. So I also noticed that you recently expanded your sustainable line of ETFs. So talk a little bit about why you are investing in that space.
Yeah, and I realized I never answered your question on the new funds we launched in Megatrends. So if I can just take one moment on a soapbox there.
Please. Yes, please.
We did expand our lineup, and I think our lineup will continue to expand and evolve as these trends continue to emerge and evolve. But we recently launched 3 transparent active ETFs and 1 index tracking ETF, all of which play off of Megatrends themes. The transparent active funds are really focused on innovative and emerging companies across healthcare, technology, and then an innovators ETF, which takes a multi-sector approach. And then our index-based ETF is a virtual work and life multi-sector ETF, again, which focuses not just on technology in this virtual world, but really taking a multi-sector approach to what is playing out in our day-to-day as we all increasingly are working more remotely and adopting a more virtual way of life. So I think those funds are critical. Alongside that, we have also continued to invest in our sustainable platform, as you said. When we think about sustainable investing, BlackRock projects that there will be over $1 trillion of indexed sustainable solutions globally before the end of the decade. And this is really driven by 4 key forces. First is the recognition that sustainability-related issues do impact risk and return. And I'll give you a couple examples of what I mean by that, because that sometimes seems like a controversial statement. And I think when we bring it to life through real life scenarios that we've all probably experienced or at least seen in the news, it becomes a little more relevant. Second is better data. So we have seen an improvement in access to the data. Sustainability risks themselves are not new, but our access and ability to quantify them, to measure them, and to control them has certainly improved. And as a result, we can incorporate them more explicitly into investments. And in the case of our projections, around $1 trillion specifically into indexes. Third is that sustainable data, because it's becoming more mainstream, is becoming far more accessible in an inexpensive manner. And fourth is, as we see this data become more accessible, an increase in products, it means there are now going to be, and are even today, sustainable solutions for every portfolio. So sustainable doesn't have to become or be a niche thing anymore. It has really become a mainstream investment risk and performance-based decision. So we've continued to expand our lineup there, and I think will continue to. If I could just give you a couple examples of what we mean when we say sustainability risks are real risks. So let's talk about, and I'm not going to name names here because it's not about any particular stock, but recently, I live in San Francisco or in Oakland. Recently, we experienced the bankruptcy of a public utility whose infrastructure failures are alleged to have caused massive wildfires across one state in particular. Some of the vulnerabilities were certainly driven by climate change, and the financial damage and the human toll was massive. And we continue to see that toll, whether it's caused by a utility or not, accelerate as this year has evolved. The impact on this company, the financial impact on this company, is that they declared bankruptcy and their bond rating fell from investment grade to junk. For any investor, that has a real world impact to them. And so by choosing to invest in companies that are better managing risks, in this case, we could call that climate risk, we can call it a governance risk over the infrastructure of their utilities, those risks should be managed, and if not managed well, can have a financial impact. We've also seen, as we've moved to this more virtual world, life has become far more online. And as a result, companies, and there have been a few in the last year or so that have fallen victim to data breaches, those have real financial impacts. It affects their stock prices, and it in particular affects their credit ratings. And so as investors, we need to be, and now can even more in a more forward manner, consider and control for risks of investing in companies that are not managing their sustainability related criteria or risks and concerns as effectively. And so that's really what we're trying to play into here. It's, I think sustainable investing used to be a values-based exercise. And for us, the proliferation and availability of data have really made it far more a quantification of risks and appropriate management of those risks in a portfolio.
I totally agree with you. Climate or sustainability related risks, those are something that we cannot ignore at all. And companies that manage those risks better will definitely outperform going forward. And Holly, I noticed that you also launched a suite of ESG screened ETFs recently. So could you talk a little bit about that suite of ETFs?
Yeah, thank you for asking. It has certainly been a big month of product development for us. When I mentioned the kind of the four key drivers that we think are leading to what should be an exponential increase in index-based sustainable assets moving forward, one of those key trends was sustainable solutions for every portfolio. We feel like it's really important to continue to provide investors multiple ways to tap into sustainable investing based on their own preferences. When it comes to ESG solutions, I think there are really two common approaches for constructing portfolios. The first is to remove companies with controversial business activities that pose elevated sustainability risks or that don't align with investor preferences. So screened funds like our recently launched, as you mentioned, S&P screened products, XVV being an example of one of those tickers that's S&P 500 focused, align with this approach. So they're simply trying to avoid investment in companies that perhaps are engaging in controversial business activities. The second is to incorporate ESG research to increase your exposure to companies that are better suited to manage sustainability risks. And so what this means is give more weight or amplify your exposure to companies that are really managing these risks properly, while perhaps on the side incorporating reducing investment in companies that are managing those risks less well. Funds in our Aware suite, like ESGU, represent this priority and this style of investment well. And for that latter approach, oftentimes we're talking with an investor who's very benchmark centric. So they want sustainability improvement in their portfolio, but they don't want to take on a lot of tracking risk. So depending on the priority, if the priority is avoiding companies that are specifically engaging in controversial activities, then screened suites like our recently launched S&P suites can certainly cater to that investor type. And for those that are looking for modest sustainable uplift in their portfolio while maintaining alignment from a performance perspective with a cap-weighted benchmark, then a more optimized approach can be appropriate for those investors. So in the end, what we're trying to do is respond to varieties of investor demand and bring choice to their portfolio construction process.
Excellent. We know that there's a lot of investor interest in ESG ETFs, and iShares has an excellent suite already. And there are some more now. There are some more options depending on investors' preferences. Some other ETFs that they can invest in. Definitely worth a look. Now, going back to your Megatrends suite, just a bit. I had Jeff Spiegel, who is U.S. head of Megatrends at your company, back on the podcast in June. And for listeners who are interested in Megatrend investing, they should definitely listen to that episode. We discuss your robotics ETF, IRBO, your cybersecurity ETF, iHack, and your genomics ETF, iDNA, in detail on that episode. Now, you talked a little bit about the new ETFs, and I noticed that some of them, three of them, which are actively managed, they bear the BlackRock brand, and the one which is passively managed, and again, a very interesting one, IWFH, that has iShares brand. So I was just curious, how does iShares partner with BlackRock on these areas of product development?
Yeah, so iShares is a brand within BlackRock. iShares ETFs have traditionally been index-based ETFs, and as we have seen increasing interest in the vehicle for investment, the ETF vehicle for investment, it means that we've continued to expand the types of strategies that we're able to wrap within that structure. And so, yes, the BlackRock branded ETFs, Future Health, BlackRock Future Tech, and BlackRock Future Innovators, all carry that BlackRock moniker that signifies that they're actively managed, and these are transparent or active transparent ETFs. Whereas the iShares Virtual Work and Life multi-sector ETF is index-based. When we think about bringing solutions to ETFs, we're going to bring the solution in the format that is most salient to the investment we're trying to capture. And we have a whole lineup of active ETFs, some of which, like the BlackRock, we have a multi-factor factor rotation ETF, ticker DYNF, that also came out under the BlackRock brand that leverages our factor-based strategies insights. So when we think about packaging investment solutions, it's about packaging IP and all the best IP that we can find. In the case of our Megatrends launches, we partnered with our fundamental equities team. In the case of our factor rotation ETF, we partnered with a factor-based strategies group, and we continue to innovate with teams internally, both active, or rather across our active spectrum, to think about solutions that would benefit from the ETF structure. So I would say, we're one big firm. It's an incredibly matrixed organization, and we partner very well with all of our investment teams. Sometimes we're partnering with index providers if bringing an index solution, but if we're bringing an active solution to the table that packages our own internal best-in-class IP, then we will just work very closely with those investment teams to make sure that we're bringing their investments to life in a way that's beneficial for investors in the ETF structure.
Makes a lot of sense. That's all we have time for today. Thanks a lot, Holly, for very insightful discussion and very interesting discussion.
Yeah, thank you so much, Nina. It's been lovely.
Thanks for listening. If you want to learn more about these ETFs, please visit iShares.com. If you like our show, please leave us a rating on iTunes or wherever you get your podcast. And also make sure to subscribe so you do not miss out on any episode. If you have any comments or questions, please email podcast@saks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.